Hello, it's Monday again, World Economic News. We'll start with the United Nations chart on food prices around the world. And you can see quite easily you've got real prices at the bottom and nominal prices at the top. But either way you look at it, you can see that it was really flat from 1990 up to 2003, then it creeped up to 2007 and then went berserk in 2008. And that caused riots in the world. But the recession that might have even been caused by those price rises, they dropped off. The prices dropped off in the recession, but you can see it's crawling all the way back up to where it was. In fact, they're over the 2008 prices now. And it seems to be causing riots again. Will it be another recession, though? Maybe not. There's probably no direct cause, but it's certainly something to be looked at, isn't it? There's something wrong, we can say there, that it was so flat for so long, then it goes up from 03 to 07, goes berserk up to 08, drops back in the recession, and now has gone up really quite quickly again lately. You can see the last 6 months it's really rising very sharply. There may be trouble ahead. Right, US Treasury yields, the 10-year. The idea is here, has the secular decline in bond yields come to an end? Secular, as in, lasts for an awful long time. And we can see it going back to 1980. They've put the little line in from 1986 or 7, and tickety-tickety-tick, it's gone down and down and down and down. But you can see on that red line, from 2000 and late 2009, early 2010, it's kind of on its way back up again and could well break up above that red tickety line. And the idea is, has the secular decline in bond yields come to an end? Bond prices down, yields up. Okay? Question mark. Big question mark. And the question mark here I've kind of established how, or tacked on another couple of question marks, and maybe an exclamation mark, and then another question mark. Because these are Japan's government 10 years, going back to 1998, but you can see around 1990, so a 20-year period here. It's gone down and down all the way to 1998, 99. That could be the equivalent of the US secular decline. Could be, who knows. But then from there on, it hasn't gone uppity up. It's gone along the ground. It's just hit the ground and crawled along there. Now we have to think or imagine or try and work out why the United States Treasury yields might rise where the Japanese for the last 10 years haven't. I don't know the answer, by the way. Getting more to the nitty-gritty of things, and I'm going to press this Fed chart one more time because I don't think it can be pushed too often. It's the M ratio, the amount of people employed compared to the population. And just to have one more look, I'd suggest from 1970 up to 1999, that was a secular trend upwards, and now we've had 11 years of a complete change in direction, haven't we? Really, that little stoppage or that little kink up was the housing bull market, the housing madness that made that small kink up in the line, which is otherwise downwards. Less people are being employed in the United States as a percentage of the population. And from that we can just get a real good understanding that something has changed, something is wrong, if it is wrong to have unemployed people hanging around doing nothing. And for most economies we can say that that is wrong. So there is something wrong. Okay, FT Alphaville, I'll finish with this. And the article is Prepare for a Major Market Overreaction. And there's a bit of explanation here, but not complete explanation of what I've been talking about, because complete explanation, if anybody knows it, it would take an awful long time. And I doubt if anybody really knows. Anyway, regular readers will know that we have often noted that core inflation tends to fall most in the early phases of economic recovery. See the chart below. Yeah, I'll do that again, because it's this is not easy to understand if I do it too quickly. Regular readers, this is Albert Edwards of SocGen, will know that we have often noted that core inflation tends to fall most in the early phases of an economic recovery. Early phases of economic recovery, core inflation falls most. The early phases of recovery. Not, as most expect, actually in the recession. Okay? The reason is very simple. At the early stages of the recovery, productivity growth rises rapidly. This is at the early stages of the recovery, productivity growth rises rapidly, driving down unit labour costs and giving companies the opportunity to cut prices. They get more efficiency, so it gives them more wiggle room to cut prices to try and carve out more of a market share for themselves, because they've let people go, and they can pull prices down slightly with that wiggle room that they've got from letting people go, and pull prices back slightly so they can get market share. But later on in the cycle, that's in when recovery might be taking place, or just later, unit labour costs pressure, as in they can't keep people's wages down indefinitely, and they can't keep laying people off. Pressure tends to rise, putting cyclical upward pressure on inflation. In other words, then they just get crushed, and they really have to put prices up. And now, obviously, their input prices are rising as well for goods, and they're getting crushed on making profits, because they've got to make it somewhere. So they really want to put prices up. Inflation, price inflation. There's the chart. You can see, you will have run through that. Later we get, I would now expect core inflation to begin its normal cyclical uplift as we move deeper into the economic cycle. We just move on. And given the jitters that abound about the impact of QE on inflation, you know, everyone's talking about it, this inflation in prices that we see is all being blamed on QE, or, you know, a lot of that talk is abounding. I would expect the markets to overreact to these developments. In other words, they'll try and confirm their own thoughts and say, told you so, and now looks what's happening. Many market participants who believe an inflation takeoff is just around the corner will then have more evidence to berate central banks for being well behind the tightening curve. Tightening curve, in other words, they've left their trousers on the ground too long. They need to pull their trousers up and tighten the belt, in other words, to raise interest rates. Any decisive, this is later again, any decisive break above 4%, in other words, prices go down on treasury bonds, call them bonds, prices down, yields go up. Any decisive break above 4%, that's particularly on the 10-year probably, is likely to trigger a melt up in yields. In other words, everyone goes, whoa, and sells off their treasuries, price goes down, yields go up, which will, in retrospect, prove to have been a total overreaction to what are normal cyclical trends. In other words, it's not a great big new coming of inflation, it's just what normally happens. Therein lies the near-term risk, but also the medium-term opportunity. As long as you're equipped with this information, that it's not the great inflation coming, you can profit from it, in principle. He finishes with, so despite Ben Bernanke's firm denials that QE is not responsible for higher global food prices, and hence higher Chinese inflation, to the extent that he is totally wrong, the Fed's QE policies are likely to have a ruinous effect on both bond and equity prices in the near term. The bond prices are likely to go down, interest rates up, and equity prices are likely to go down because profits are likely to get squeezed because the companies haven't got wiggle room to put their prices up and things like that. See you tomorrow. Bye.